Usually when we talk about a medical diagnosis, there's this expectation of, well, absolute precision.
Oh, absolutely. It's very binary, right?
Right. It feels almost like engineering. I mean, you fall off a ladder, your arm hurts, you go to the hospital.
And you get the x-ray.
Exactly. You get the x-ray. It shows that jagged white line on your humerus, and a doctor just points at the illuminated screen and says, there it is. That's the fracture.
Yeah, it's a clean, observable fact. You can literally see it.
Exactly. It's either broken or it is not broken.
Yeah.
And as humans, I think we find that incredibly comforting. We really like our problems to be visible, physical and just easily categorized.
We do. Because that physical visibility is reassuring. I mean, if you can see the break, you can understand the mechanism of the cast they put on it.
Right. The treatment makes sense.
Exactly. The treatment logically follows the observable damage. It's cause and effect.
But then, and this is where we're getting into today, you step into the modern world of complex financial reporting.
Oh, boy.
And suddenly that trusty X-ray machine is it's completely useless. I mean, we are looking at a diagnostic landscape that is intentionally murky.
Very murky, sometimes by design.
Right. We're dealing with invisible transactions, zero-cost movements of immense wealth, and these standard rule books that basically force you to look far beyond what simply happened on a piece of paper.
Because you have to see what the underlying economic reality actually dictates, not just the ink on the page.
Exactly. And that is exactly why we are unpacking this specific material today. So welcome to a new episode on the Gap Advisors Ind AS Clinic podcast.
Glad to be here for this one. It's a great case study.
It really is. We have a deep dive today that is going to fundamentally challenge how you view corporate wealth. It's just wild.
It really is a paradigm shift. I mean, we are basically examining the underlying code of the financial matrix today.
The matrix. I love that.
Yeah, and what is consistently fascinating about this code is how often it executes in ways that, well, completely contradict our basic everyday common sense regarding money.
It really does. I mean, we are going to dissect a corporate transaction today that costs absolutely nothing.
Literally zero.
Zero cash changes hands between the parties. And yet, this completely invisible, costless event fundamentally alters the reported public-facing profit of a major corporate entity.
Which is huge. It changes the whole picture.
It changes everything. Which brings us to the most critical question of this entire deep dive. And I want to pose this directly to you, the listener.
It's the most important question we can ask.
Right. Why should you care? I mean, why should you or anyone investing their hard-earned money in the shares of a listed company care about the microscopic, highly technical nuances of Indian accounting standards?
A lot of people tune out when they hear accounting standards.
Exactly. If you are a regular retail investor analyzing a stock on your phone or, maybe a mid-level manager prepping for a departmental budget meeting, isn't this hyper-technical framework just something for the back-office auditors to sweat over?
Well, believing that accounting standards are just back-office plumbing is, I'd argue, the single most dangerous misconception in the modern financial world.
Wow. The single most dangerous.
Without a doubt, think about it. You, as an investor, you make your capital allocation decisions based on the information that companies feed you, right?
I look at the numbers.
Exactly. And the crown jewel of that information, the number that flashes in green or red on financial news networks, is the profit number.
The bottom line.
The bottom line. That single figure is the headline of every quarterly earnings report. It dictates the earnings per share.
Okay, yeah.
And that earnings per share is fed into valuation models, which ultimately drive the share price you pay in the open market. But here is the brutal reality, and this is what people miss, that profit number is not a universally objective fact like gravity.
Or the speed of light.
Right. It is a highly engineered calculation dictated entirely by the boundaries of accounting standards.
So it's basically a constructed reality. So if you don't understand the specific rules of how a company is legally allowed to calculate its profit, you are essentially flying blind in a hurricane.
You really are. You could easily be pouring your life savings into a company that looks incredibly historically profitable on paper.
Right.
But that profit might be entirely generated by brilliant accounting adjustments rather than actual cash-generating business operations.
That is terrifying. It's like trying to bet your life savings on a professional sports game without understanding how the referees are instructed to score the points.
That's a perfect analogy. You absolutely have to know the rules of the game.
Okay, so before we officially dive into the deep end of today's specific set of rules, we are required to lay down our foundational groundwork and a non-negotiable disclaimer.
Yes, this is critical context for our discussion today.
Go ahead.
We must clearly state that the views expressed in this deep dive are the personal views of the author of our original source material and our own interpretive analysis of that material.
Right, just our take on it.
Exactly. These views are not binding on you, the audience, in any legal or professional capacity. We strongly advise that you seek the help of a qualified professional expert before taking any action or refraining from any action based on the theories discussed today.
Because every situation is different, right?
Precisely. Every real-world corporate scenario has its own unique, highly specific facts and circumstances. I mean, literally, a single comma in a legal contract can change the entire accounting treatment.
A single comma. Wow.
Oh yeah, so a broad analytical discussion like ours cannot replace targeted, bespoke professional advice.
Understood. With the legal guardrails firmly in place, let's establish the absolute baseline for the financial universe we are simulating today. Because whenever we analyze a case study, we need strict parameters, to prevent external variables from muddying the water.
Always. You have to isolate the variables.
Right. So for today's scenario, we are laying down two universal ground rules. First, the functional and presentation currency for all the entities we are discussing is strictly the Indian rupee, or INR. That means any other currency, US dollars, euros, yen, is automatically classified as a foreign currency.
And we want to avoid that today.
Exactly.
Yeah.
If we introduce foreign currency, we would trigger Ind AS 21, forcing us to calculate foreign exchange gains and losses, which would just totally distract from the core issue.
It gets very messy very quickly.
Yeah, so we are operating in a pure, insulated, all INR world. Second ground rule. The reporting period for our hypothetical companies strictly runs from the 1st of April to the 31st of March.
The standard Indian financial year.
Yep. So when we discuss end-of-year reporting or, a year elapsing, we are eyeing that specific March 31st finish line.
Establishing those boundaries is so helpful. It isolates our variables. We know exactly what calendar governs the timeline and what currency we are measuring the impact in.
Pure focus.
Exactly. It allows us to focus our analytical lens entirely on the mechanics of the transaction itself without ambient noise.
Okay, let's unpack this transaction. We are looking at a fascinating multi-layered maneuver. It involves three key elements. We've got a holding company, a subsidiary company, and a mysterious issuance of zero-cost bonus shares.
Sounds simple enough.
It does. If you just read the press release, it sounds like standard, incredibly boring corporate housekeeping. But as we peel back the legal veneer, it reveals itself to be an absolute accounting thriller. So let's deconstruct the foundational facts of the case right from the top.
The premise is deceptively elegant, which, in the world of financial reporting, is almost always a warning sign that something highly complex is buried beneath the surface.
A huge red flag.
Yep. So, we have a subsidiary company. The subsidiary issues new shares to its parent company, the holding company.
Yeah.
However, they don't issue standard equity shares, and they don't ask the parent for a single rupee in exchange.
So it's free.
Free. They specifically issue Redeemable Preference Shares, or RPS, and they issue them entirely as bonus shares.
Let's halt the train right there and put this entire structure under the microscope. Because every individual word in that setup is loaded with legal and financial implications.
It really is.
Let's start with the relationship architecture. Holding company and subsidiary. For anyone listening who might manage a small business or invest primarily in index funds, how should they visualize the barrier between these two entities? Because it's not just one big corporate blob.
No, it is vital to separate them in your mind. Think of it as a parent and an adult child.
Okay, parent and adult child.
Legally, they are distinct, sovereign individuals. The subsidiary has its own corporate registration, its own dedicated bank accounts, its own employees, its own legal liabilities, and crucially, its own separate standalone financial statements.
So they're fully independent on paper.
Yes, but the parent, the holding company, exerts control over the child, usually by owning more than 50% of its voting equity stock.
Right, so they pull the strings.
Exactly. Because of this voting control, their strategic destinies are deeply interconnected. However, and this is key corporation law and accounting standards, require us to evaluate their individual financial health completely separately before we ever attempt the complex math of consolidating their books into one master financial statement.
Right. You can't just mash them together on day one.
You absolutely cannot. Therefore, when the subsidiary initiates a transaction, it creates a specific impact on its own standalone books, and it triggers a corresponding but potentially radically different accounting reaction on the parent's standalone books.
Right, so the child entity is handing an asset up the corporate ladder
Mm-hmm.
to the parent entity, and what they were handing up is explicitly labeled as bonus shares.
Bonus shares, yes.
Now, in layman's terms, when I hear the word bonus, I think of a year-end cash envelope for hitting my sales targets.
Sure, everyone loves a bonus.
Exactly. Or, in the context of my personal retail stock portfolio, if I own 10 shares of a massive tech company and their board declares a one-for-one bonus issue, I just wake up one morning and my brokerage account magically holds 20 shares.
Just like that.
Just like that.
Yeah.
I didn't wire them any cash. My acquisition cost was strictly zero, but my share count doubled.
That is the traditional, widely understood definition of a bonus share, often referred to globally as a scrip dividend.
Right.
It is a free share of stock allocated to existing shareholders in direct proportion to the number of shares those shareholders currently hold.
Right, and how do they actually fund that?
Well, companies typically execute this maneuver by tapping into their accumulated historical profits or capital reserves. They are essentially capitalizing their own success.
Meaning what, exactly?
Meaning they're taking liquid value that could theoretically have been paid out to investors as a cash dividend and permanently cementing it into the company's formal share capital structure.
I see.
So for a normal equity shareholder, as you noted, the sheer number of shares they hold increases, but their proportional ownership slice of the company remains identical.
Right, because everyone else got them too.
Exactly.
Right.
If you owned a 10% stake in the total pie before the bonus issue, and the company doubles the total number of outstanding slices, you still only own 10% of the pie. The pie itself hasn't grown, it has just been subdivided.
But here is the massive, jagged twist in our source material that derails that traditional understanding.
Here we go.
The subsidiary in our case study did not issue standard garden variety equity shares. They issued redeemable preference shares.
Yes, RPS.
And there is an unavoidable legal catch attached to these specific instruments. The source document states explicitly, the RPS are to be redeemed at par after 1 year.
That is the kicker.
Now, I have to deploy an analogy here because this feels fundamentally contradictory to me. Let's say it's my birthday.
Happy birthday.
Thanks. You hand me a beautifully wrapped box, and inside is a piece of paper that says, bonus. You get 1,000 rupees. That is a fantastic gift.
You're welcome.
But what if you hand me a piece of paper that says, bonus? I am forcing you to accept this document, and exactly 365 days from today, I am legally obligated to track you down, take this document back from you, and hand you exactly 1,000 rupees in physical cash.
Oh.
Is that actually a bonus share, or did you just hand me a legally binding IOU dressed up in wrapping paper?
That analogy perfectly isolates the friction point of this entire deep dive. You are articulating the eternal war in accounting between legal form and economic substance.
Legal form versus economic substance.
Exactly. Legally, the piece of paper is formally titled a share. It is issued under the strict governance of the Companies Act as a component of share capital. It sits in the share registry.
Looks like a duck, quacks like a duck on paper.
Right, but economically, exactly as your birthday analogy highlights, it is a ticking time bomb of a mandatory cash obligation.
A ticking time bomb.
It is. The subsidiary has not granted the holding company a permanent, perpetual slice of ownership risk. They have granted them a fixed, unalterable promise to deliver cash, specifically, to redeem the shares at their par value in exactly 1 year.
Which naturally forces us to ask the strategic question. Why on earth would a highly paid board of directors jump through these complex administrative hoops?
It does seem like a lot of work.
Right. If the subsidiary knows they want to transfer cash to the holding company in exactly 12 months, why not just wait 12 months and declare a normal cash dividend?
Or just wire the money.
Exactly. Or, if the holding company needs certainty now, why doesn't the subsidiary just take out a formal, standard corporate loan from the parent? Why play this elaborate game of dressing up a future cash payment as a zero-cost bonus share?
Well, our specific source document strictly provides the accounting facts and refrains from speculating on the underlying boardroom motives. Any seasoned professional looking at this structure can infer a few classic strategic drivers.
Okay, let's hear them.
Frequently, this architecture is driven by aggressive tax planning or intricate capital structuring.
Shocking.
I know, right? Consider liquidity, for instance. Perhaps the subsidiary is highly profitable on paper, but is currently cash poor. Maybe all their capital is locked up in new manufacturing equipment.
So they literally don't have the cash to hand over today.
Right. They physically cannot pay a massive cash dividend today. However, the holding company might desperately need to show a bolstered asset base on its standalone balance sheet to satisfy the strict covenants of its own external bank loans.
Ah, the plot thickens. The parent needs the balance sheet boost.
Exactly. By issuing these shares, the subsidiary creates an asset for the parent without draining its own current cash reserves.
That is sneaky, but brilliant.
And furthermore, depending on the specific jurisdiction and historical tax codes, the tax treatment of receiving redemption proceeds from a preference share can sometimes bypass the heavy dividend distribution taxes that would normally apply to a standard cash payout.
So it's a tax dodge, too.
Well, let's call it sophisticated financial engineering. It's designed to navigate legal, tax, and liquidity constraints simultaneously.
Sophisticated financial engineering. I love that term. It is the corporate equivalent of threading a needle while blindfolded.
Basically.
But regardless of their secret strategic motives, the transaction has been executed, the legal documents are signed, so we have to deal with the forensic aftermath. Let's examine how the subsidiary handles this detonation on their own books.
Okay, let's look at the subsidiary.
The source document provides a crucial breadcrumb here. It states, in subsidiary books, the RPS would be shown as a liability and retained earnings would be debited.
Right.
Can we walk through the foundational mechanics of that entry? Because to an outside observer, if a company issues something called a share, putting it in the liability column feels like a typo.
This apparent contradiction brings us back to that doctrine of substance over form, which is the absolute bedrock of modern accounting frameworks like Ind AS.
Right. It doesn't matter what you call it.
The standard does not care what fancy title the lawyer stamped at the top of the document. The standard interrogates what the document actually compels the company to do.
And it compels them to pay up in a year.
Exactly. Because the subsidiary is under a strict, unavoidable contractual mandate to redeem these shares in exactly 1 year, they possess a present obligation to part with economic resources cash in the future.
And an obligation is debt.
By definition, a present obligation that requires an outflow of cash is a liability. It is debt. Calling it a share does not shield it from being classified as debt.
Okay, that makes logical sense. The subsidiary is forced to create a new liability on its balance sheet.
Yes.
Let's assign a hypothetical value to make this concrete.
Okay, let's use some numbers.
Let's say the par value of these shares is 10 million rupees.
Sure, 10 million.
The subsidiary now has a 10 million rupee liability glaring on their books that did not exist yesterday. But the fundamental law of double entry bookkeeping dictates that the balance sheet must balance.
Every credit needs a debit.
Exactly.
Yeah.
Every credit requires an equal debit.
Yeah.
Where does that massive offsetting debit go?
Well, the source explicitly notes that retained earnings would be debited. Let's conceptualize retained earnings for a second.
Please do.
Imagine it as a massive, secure corporate pantry sitting inside the equity section of the subsidiary's balance sheet.
A pantry. Okay, I like this.
Every single year, the subsidiary operates efficiently and generates a net profit. They stock that pantry with jars of preserves representing accumulated wealth.
Nice.
Every time they suffer an operational loss or decide to pay out a standard cash dividend to their shareholders, they physically remove jars from that pantry.
Right. It is the cumulative historical scoreboard of their entire operational success. It's the stored wealth.
Precisely. So by executing this bonus share issuance, the subsidiary is essentially making a deliberate decision to unlock that pantry.
And take out the jars.
Right. They are scooping 10 million rupees worth of stored wealth out of that accumulated profit bucket, debiting the retained earnings, which reduces the balance, and transferring that exact value over to the liability column.
So they're moving it from wealth to debt.
Exactly. They're effectively communicating to the market, we are taking a portion of the historical profits that rightfully belong to our shareholders, but instead of handing it to them in liquid cash today, we are converting it into a formal, binding debt contract that we swear to pay them in exactly 12 months.
When you break it down like that, the subsidiary's accounting logic is actually airtight. They simply converted their own historical profit into a future IOU.
That's all it is.
But, as our source material clearly dictates, the subsidiary's accounting isn't the real puzzle we are here to solve.
No, the subsidiary side is the easy part.
The core issue, the actual diagnostic query we need to resolve in this clinic, lies on the other side of the transaction. How does the holding company account for receiving this instrument?
And that is where the real intellectual heavy lifting begins.
Because the holding company's problem sounds laughably simple at first, but it quickly becomes mathematically infuriating.
Infuriating is a good word for it.
The transaction price, the amount of cash they paid to acquire these shares, was NIL. Zero. Zilch.
Not a single rupee.
They woke up, opened an email, and received a certificate for 10 million rupees worth of redeemable preference shares.
Which naturally triggers a massive philosophical collision with an accounting theory.
Exactly. So let me represent the skeptical listener here and play devil's advocate.
Go for it.
If I am walking down a dirt path and I find a perfectly smooth, shiny pebble on the ground, I pick it up. It's a nice pebble.
Sure, nice pebble.
But I do not sprint back to my office, open my personal financial ledger, and record the pebble as an asset.
No, you wouldn't.
It didn't cost me anything to acquire it. Why can't the holding company just take this digital certificate for bonus shares, drop it into a secure digital folder, say cool free shares, and completely ignore it on their balance sheet?
I mean, it sounds tempting.
Right. Why are they forced to do any accounting whatsoever if the initial transaction price was zero?
So if we can't just ignore it, how do the rule makers legally force us to categorize this mutant asset?
Well, if we relied purely on the antiquated system of historical cost accounting, the old school method where you only ever record what you actually paid hard cash for, your shiny pebble theory would be completely valid.
Yay for the pebble.
If you paid zero, your ledger reflects zero. But Indian accounting standards, specifically the Ind AS framework, fundamentally reject that premise.
They don't let you do that anymore.
They do not allow you to ignore economic reality. The holding company now possesses a legally enforceable, ironclad right to extract 10 million rupees in cash from the subsidiary in exactly 1 year.
Which is very different from a pebble.
Right. That contractual right holds immense, undeniable economic value. If the holding company deliberately leaves that right off their balance sheet, they are drastically understating their true financial firepower to their investors and creditors.
Which is basically lying by omission. Exactly. The rules dictate we must recognize it. But before we can even begin to assign a numerical value to it, we have to pass a vital diagnostic test. We have to definitively figure out what species of asset we have captured.
Which directs us straight to Ind AS 32.
Yes, in AS 32.
This standard is the ultimate litmus test. It is titled Financial Instruments Presentation. Paragraph 11 of this standard acts as the supreme gatekeeper. It provides the rigid, unforgiving definitions of what constitutes a financial asset, what constitutes a financial liability, and what truly qualifies as an equity instrument.
Our source text provides a massive foundational assumption right out of the gate regarding this test. It states, in absence of information, it is assumed that the redeemable preference shares issued by the subsidiary as bonus shares does not meet the definition of equity instrument in paragraph 11 of Ind AS 32.
That's a huge assumption.
It is. We need to deeply analyze why that specific assumption is the linchpin of the entire accounting treatment. The physical document clearly has the word share printed in bold ink. Why does Ind AS 32 ruthlessly strip away that title and declare it is not equity?
Let's loop back to the birthday gift analogy. If true equity isn't a guaranteed payout, what is it?
True equity, in its purest economic form, represents a residual interest in the assets of an entity after deducting all of its liabilities.
Residual interest, meaning whatever is left over at the end.
Exactly. If you hold a genuine equity share, you accept the ultimate risk. You are at the absolute bottom of the priority list if the company goes bankrupt and is liquidated. The banks and bondholders get paid long before you see a single rupee.
So you could lose everything.
You could. However, in exchange for that ultimate risk, you possess infinite upside potential if the company wildly succeeds.
Right.
But the most defining characteristic of a pure equity instrument is the absence of obligation.
The absence of obligation.
It does not contain any contractual requirement for the issuing company to deliver cash or another financial asset to you. The issuer's board of directors can choose to declare dividends, or they can choose to hoard the cash for a decade.
It's totally up to them.
They can choose to buy back the shares, or they can choose never to do so. It is entirely 100% at their own discretion.
But the redeemable preference share in our scenario offers zero discretion.
Exactly zero. The critical phrase in the contract is redeemed at par after 1 year. The subsidiary has permanently surrendered its discretion.
They are locked in.
The holding company does not hold a vague residual interest in the future success of the subsidiary. They hold a locked, guaranteed right to a highly specific amount of cash on a highly specific future date.
So it's a debt.
because of that mandatory, unavoidable redemption clause, the instrument spectacularly fails the definition of an equity instrument under paragraph 11 of Ind AS 72. It cannot, under any circumstances, be classified as an investment in equity on the parent's balance sheet.
So if the standard forcibly evicts it from the equity category, where does it land?
Well, from the holding company's perspective, because it is a binding contractual right to receive cash from another distinct entity, it slots perfectly into the definition of a financial asset.
Let's pause and really solidify that concept because it is the pivot point upon which the entire case study turns.
It is the fulcrum, yes.
The holding company receives a document titled Share. But because the fine print contains a promise to pay cash next year, the accounting standard completely ignores the title. It sequences the economic DNA of the transaction, identifies the cash obligation, declares it a financial asset, and effectively says, you are forbidden from treating this like the rest of your standard stock portfolio.
That is exactly how the logic flows. And the very microsecond Ind AS 32 classifies this bespoke instrument as a financial asset, a trapdoor swings open beneath our feet, and we drop directly into the jurisdiction of a completely different, exponentially more complex rulebook.
Yes, we are entering the absolute heavyweight champion of all accounting standards.
Ind AS 109.
We are plunging into Ind AS 109 and colliding with the fair value mandate. Now, Ind AS 109 is infamous in the profession.
Oh, it causes nightmares.
It really does. It is dense, it is hyper-mathematical, and it completely revolutionized how global corporations report their financial instruments.
Yeah.
Our source text points us directly to a very specific, terrifyingly worded paragraph.
I know exactly the one you mean.
I am going to attempt to read it verbatim exactly as the law is written, but I guarantee I will sound like a malfunctioning robot.
Good luck.
Here goes. The source quotes paragraph 5.1.1 of Ind AS 109, stating, except for trade receivables within the scope of paragraph 5.1.3, at initial recognition, an entity shall measure a financial asset or financial liability at its fair value plus or minus. In the case of a financial asset or financial liability not at fair value through profit or loss, transaction costs that are directly attributable to the acquisition or issue of the financial asset or financial liability.
Wow.
Right. I read that 3 times before we started recording, and my brain still actively rejects it. What is this actually demanding of the holding company?
I know it sounds like it was drafted in ancient Latin specifically to torment finance students.
Truly.
But once you carve away the exceptions and the subordinate clauses, it is actually a beautiful, highly logical set of instructions. Let's isolate the core command.
Okay, let's start with the timing. At initial recognition, what does that mean in plain English?
Initial recognition is simply accounting terminology for day one.
Day one. Okay.
The exact literal moment the holding company receives the bonus shares into its custody and must first record them on their books. The standard is dictating the rules of engagement for the very beginning of the asset's life cycle.
Okay, day one rules. Got it. The core command seems to be, an entity shall measure a financial asset at its fair value.
That is the beating heart of Ind AS 109. The word shall is critical. It implies a mandatory, non-negotiable directive.
No wiggle room.
There are no opt-outs. You must measure this newly minted financial asset at its fair value. And this specific mandate is where we violently collide with the zero-cost reality of our scenario.
Because the transaction price, the actual physical amount of cash that transferred out of the holding company's bank account to acquire these shares, was zero.
Zero.
But the standard flatly ignores the transaction price. It demands fair value.
Right.
I want to challenge this heavily because we need to thoroughly unpack the philosophical and mathematical chasm between those two terms.
Please do.
To a rational layperson, if I pay zero for something, its value to me in the context of that specific transaction is zero. Why am I forced to invent a different number?
This is the crux of modern financial reporting. Let's clearly delineate the two concepts. Transaction price is purely historical. It is backward-looking.
It's what already happened.
Exactly. It is nothing more than the factual, audited record of what consideration was actually exchanged between the specific parties. In this isolated case, zero. Fair value, however, is a radically different, forward-looking, market-based concept. The Ind AS framework defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between independent market participants at the measurement date.
So it's forcing the holding company to ask a completely hypothetical question.
Mm-hmm.
If I took this bespoke preference share contract right now, walked out of my office, and tried to sell it to an independent, ruthless third-party investor on the open market, What is the maximum amount of cash they would be willing to hand me for it today?
Exactly. Let me deploy an extreme, somewhat absurd analogy to clarify why the standard forces this hypothetical
I
exercise.
love analogies. Hit me.
Imagine you are walking past a high-end luxury car dealership, and they are running an insane promotional lottery. You enter, you win, and the dealer hands you the keys and the title to a brand new, custom-built Ferrari, absolutely free of charge.
A free Ferrari.
Free. You sign the legal paperwork, and the transactional price on the receipt is strictly 0 rupees. You paid absolutely nothing.
That would be the greatest Tuesday of my life.
Undoubtedly. Now, you carefully drive that Ferrari home and park it securely in your garage. If you were managing your personal net worth using the archaic historical cost method, you would dutifully record the Ferrari on your personal balance sheet at 0 because that is what you paid.
Right. Zero cost, zero value.
But does that accurately reflect your economic reality? Absolutely not. You have a highly desirable asset sitting in your garage that you could immediately liquidate tomorrow morning for, say, 30 million rupees.
Yeah, I could just sell it.
Its fair value is 30 million rupees. If you apply for a mortgage the next day and you don't list that Ferrari as a 30 million rupee asset, you are wildly understating your wealth to the bank.
I see.
Ind AS 109 forces corporate entities to reflect that true economic reality. It demands that you put the Ferrari on your balance sheet at 30 million,
Yeah.
effectively overriding the zero-cost transaction price. Because hiding 30 million rupees of liquid value from your investors is fundamentally deceptive.
Okay, the Ferrari analogy makes perfect sense because a Ferrari is a highly liquid asset. There is a massive, observable secondary market for Italian sports cars. I can just look up the Blue Book values.
Sure.
But I have to push back here on the reality of our scenario. The holding company didn't win a Ferrari. They received a highly specific, customized, illiquid, redeemable preference share issued by their own subsidiary.
It's a very different beast.
This isn't traded on the Bombay Stock Exchange. There is no Blue Book for this. How on earth do you determine the fair value of an asset when no active market actually exists for it?
That is where the profession transitions from pure accounting into the realm of complex corporate valuation.
The dark arts.
Yeah, basically. When observable market prices do not exist, what we call level 1 inputs, Ind AS requires you to utilize robust valuation techniques, most commonly involving discounted cash flow models or DCF.
DCF. Okay, walk us through that.
Remember the core DNA of this instrument. It promises a highly specific cash payout in exactly 1 year. Let's return to our hypothetical scenario, where the par value to be redeemed is 10 million rupees. A rational, independent market participant would never pay you a full 10 million rupees today for the right to receive 10 million rupees next year.
Wait, why not? If it's a guaranteed 10 million, isn't it worth 10 million?
Because of the foundational financial principle of the time value of money, the market participant has opportunity cost.
Oh, right. Interest.
Exactly. If they have 10 million rupees in cash today, they could invest it in risk-free government bonds and earn, say, 7% interest over the next year. Therefore, a rupee today is inherently worth more than a rupee tomorrow.
Got it.
To determine the fair value today, the valuer must mathematically discount that future 10 million rupees back to its present value using an appropriate market interest rate.
So they have to calculate how much less it's worth today because of the waiting period.
Correct. And selecting that discount rate is a highly scrutinized process. You cannot just use the risk-free government rate because the subsidiary is not the government. They carry corporate credit risk.
Right, they could go under.
There is a non-zero chance the subsidiary goes bankrupt and defaults on the redemption. So the valuer must determine the specific borrowing rate the subsidiary would face in the open market. Let's assume, after analyzing the subsidiary's credit rating and current market conditions, the appropriate discount rate is determined to be exactly 10%.
Okay, so walk us through the actual math. How does that 10% discount rate translate into a fair value number for the balance sheet?
The formula for present value is the future cash flow divided by 1 plus the discount rate raised to the power of the number of periods. In our case, it is 10 million divided by 1.10.
Let me just do that in my head.
If you run that calculation, the present value, the fair value today, is approximately 9,090,909 rupees.
So despite the fact that the holding company paid absolutely zero cash, and despite the fact that the instrument is a bespoke contract with our own child entity, the rigid rules of Ind AS 109 demand they recognize a financial asset on their balance sheet for roughly 9.09 million rupees.
Yeah.
The standard forces a mathematically derived economic reality to completely obliterate the
Yeah,
legal transaction price.
precisely. And establishing that 9.09 million rupee figure brings us to the ultimate accounting puzzle of this entire scenario, the double entry dilemma.
Right, because if the holding company suddenly conjures a brand new asset and slaps it onto the left side of their balance sheet for 9.09 million rupees, their balance sheet is violently out of balance.
Lopsided.
The absolute unbreakable law of double entry bookkeeping invented centuries ago dictates that every single debit must have an equal and opposite credit.
Always.
If the holding company didn't pay any cash, meaning they cannot credit their bank account to balance the ledger, where does that massive 9.09 million rupee balancing entry go? Does it just materialize out of the ether? Is it accounting magic?
It certainly feels like dark magic to the uninitiated, but it is actually deeply logically rooted in the underlying economics of the parent-subsidiary relationship. To find the answer to where that massive credit goes, we have to look backward.
Backward to what?
We have to retrieve the crucial clue we uncovered when we analyzed what the subsidiary did on their books.
Oh, you're talking about the pantry.
Exactly. We have to remember the subsidiary's initial accounting entry. They credited a liability to represent the future payout, yes, but what account did they debit to balance their own books?
They debited their retained earnings, the corporate pantry.
It's a corporate pantry. And what is the legal and economic purpose of that retained earnings pantry for a corporate entity?
Those retained earnings represent what is legally termed distributable surplus. It is the accumulated pool of realized profits that is legally cleared and available to be distributed upward to the shareholders in the form of a standard ordinary cash dividend.
Okay, the fog is clearing.
Let me try to construct the final bridge here. If the subsidiary had simply walked into that pantry, grabbed 9.09 million rupees worth of actual cash, and wired it directly to the holding company's bank account today, we wouldn't even need to hold this clinic.
No, it would be rudimentary bookkeeping taught in the first week of university.
It would be incredibly simple. The subsidiary debits retained earnings and credits cash. The holding company receives the wire, debits their cash account for 9.09 million, and credits dividend income in their profit and loss statement for the exact same amount. Perfectly clean.
Clean and simple.
But because the subsidiary didn't have the cash or strategically chose not to deploy it, they use this complex redeemable preference share as a substitute delivery mechanism.
That is the exact in lieu of cash revelation that our source document hinges upon. This is the master key to the puzzle.
Okay, read it to me.
Let me quote the exact precise wording from the expert response. The company has received the shares as bonus shares. The bonus has been given out of retained earnings, which represents distributable surplus. Therefore, the company has received bonus shares in lieu of dividends in cash.
In lieu of dividends in cash. That is brilliant. The accounting standard is basically standing over the holding company's shoulder and saying, we see exactly what you did there. You didn't give them physical cash. You gave them an IOU.
But because that IOU was funded directly out of the distributable profit pantry, we are going to force you to treat the receipt of that paper contract exactly as if it were a receipt of physical cash.
It is the ultimate triumph of substance over form.
It really is. The undeniable economic substance of the transaction is a distribution of accumulated profits from the child entity to the parent entity.
Just in a weird wrapper.
Right, the superficial form of the distribution just happens to be a financial instrument rather than paper currency. Therefore, the resulting accounting treatment must accurately reflect a massive distribution of profits.
So let's spell out the final audited accounting entry for the holding company, loudly and clearly so our listeners can lock it in. They are sitting at their desks on day one. They have calculated the fair value of this redeemable preference share using a complex DCF model. We will stick with our derived figure of 9,090,909 rupees. What are the keystrokes?
Step 1, the asset side. The holding company books a debit entry to financial asset investment in preference shares for 9,090,909 rupees.
Okay, asset is on the books.
This places the asset on the balance sheet at its true discounted economic value, perfectly satisfying the strict mandate of Ind AS 109, paragraph 5.1.1.
And step 2, the grand finale, the elusive credit entry required to balance the books.
The holding company books a credit entry to dividend income for 9,090,909 rupees. And crucially, critically, that massive income entry flows directly into the current year's profit or loss statement.
That is absolutely staggering when you step back and look at the whole picture.
It's massive.
A transaction where literally zero physical cash changed hands. A transaction that was explicitly legally labeled as a free bonus has now not only created a highly valued financial asset on the balance sheet, but it has generated a massive 9 million rupee spike in reported operating income on the profit and loss statement.
It's wild, isn't it?
It brings us violently back to the warning we issued at the very beginning of this discussion. If you are a retail investor analyzing the holding company's quarterly earnings report, you might see a massive, unexpected jump in their net profit.
Right, you see the green arrow pointing up.
You might look at the skyrocketing earnings per share and think, wow, their core operations are absolutely crushing it. They must be selling record numbers of products.
But they aren't.
No. If you don't possess the technical literacy to dig deep into the footnotes, you will completely miss the reality that a massive chunk of that reported profit wasn't generated from selling more widgets to customers. It was artificially generated by receiving a non-cash IOU from their own captive subsidiary.
It perfectly highlights the absolute non-negotiable necessity of analyzing the cash flow statement in tandem with the P&L.
You have to look at both.
Always. The profit and loss statement will proudly display the 9 million rupees as income, inflating the EPS. But the cash flow statement from operating activities will ruthlessly reveal the truth. No actual physical cash was generated from this specific transaction during the current period.
Because it's an illusion of cash.
It is purely an accrual of abstract value based on a binding future promise. The cash won't materialize until day 365.
Wow. Now, before we pivot away from the mechanics, I want to address a critical question for our global listeners. We have spent the last hour speaking very specifically about Ind AS, the Indian accounting standards. We've cited Ind AS 32 and Ind AS 109 extensively.
We have.
If someone is listening to this clinic in London or Dubai or Toronto, and their corporation operates under IFRS, the International Financial Reporting Standards, can they just tune this out? Is this entire zero-cost bonus share mechanism just a bizarre quirk of the Indian regulatory system?
That is a vital point to clarify, and the short answer is this applies entirely and identically to them.
Oh, really?
Identical. Yes. While the authoritative response in our specific source document is delivered strictly under the Ind AS framework, it is critical for global professionals to understand that the Indian accounting standards are deeply, fundamentally converged with IFRS.
So they're basically twins.
Exactly. In fact, for the highly complex topics of financial instruments, fair value measurement, and equity classification covered in Ind AS 32 and 109, there is virtually zero daylight between Ind AS and their global IFRS counterparts, IAS 32 and IFRS 9.
So the DNA is the same.
Exactly the same. The underlying economic logic, the strict definitions separating equity from liability, the absolute mandate for day one fair value measurement using discounted cash flows, and the realization of dividend income from a subsidiary's retained earnings. All of these core principles are identical across both frameworks.
That's fascinating.
Therefore, this exact same rigorous logic and resulting accounting entry can and legally must be applied by any corporate entity globally that is operating under the IFRS framework when confronted with a similar zero-cost bonus share scenario.
So the principles of economic substance over legal form are universal. Whether your balance sheet is denominated in Indian rupees, euros, or Japanese yen, if you receive a guaranteed contractual promise of future cash disguised as a free equity share, the global accounting consensus forces you to aggressively strip away the disguise, mathematically value the promise, and immediately recognize the economic gain.
That's it in a nutshell.
It's a brilliant airtight system once you understand the underlying mechanics. But that realization leads me to a very practical, almost existential question.
What's that?
Let's be brutally honest. Figuring this out from scratch using only the raw text of the standards is incredibly difficult. If I'm an auditor or the newly appointed CFO of a mid-sized holding company and my subsidiary drops this bespoke transaction on my desk on a Friday afternoon, I would pull my hair out.
Oh, Friday afternoon surprises are the worst.
I would spend weeks agonizing over the dense lawyer-speak paragraphs in Ind AS 109 and trying desperately to justify my journal entries to the audit committee. How do actual professionals survive this? Where do the experts go for bulletproof answers when they face these hyper-specific, real-world boardroom crises?
Well, they do not rely on standard textbooks, and they certainly don't try to reinvent the wheel every single time.
Because there's no time for that.
Exactly. They survive by relying on highly specialized, heavily curated repositories of applied knowledge. The intricate scenario we unpack today did not originate in an academic vacuum. It was pulled directly from the massive issue repository hosted on gadadvisors.com.
I want to spend a moment on that repository because when I first comprehended the sheer scale of it, I was genuinely blown away.
It's massive.
We're talking about an online platform that currently hosts over 4,500 real-world, highly complex issues and their detailed technical responses covering both the Ind AS and Indian GAAP frameworks.
It is an unparalleled survival tool, particularly for practicing audit professionals. Consider the immense burden of proof placed on a modern auditor by regulatory bodies like the PCAOB globally or the NFRA in India.
They are under so much pressure.
Huge pressure. When an auditor is reviewing a complex, high-stakes transaction like the zero-cost bonus shares we analyzed today, they cannot simply look at the CFO's spreadsheet, nod their head, and say, looks reasonable.
Right, that won't fly anymore.
That is a fast track to regulatory sanctions. They are required to meticulously document their working papers. They must cite the specific, granular paragraphs of the standards, thoroughly explain the economic logic, and fiercely defend exactly why a certain treatment was accepted while alternatives were rejected.
Which is where the repository comes in.
Having instant access to a searchable database of 4,500 pre-analyzed, expertly resolved issues is equivalent to having a dedicated army of technical accounting experts sitting in your corner. It provides the rigorous, bulletproof documentation that auditors desperately need to defend their sign-offs.
And what I find most remarkable is the accessibility of this tool. Anyone listening to this deep dive right now can open their browser and register completely for free on gapadvisors.com.
Yes, entirely free to register.
And once you are inside, you aren't just limited to passively searching the historical archives. If you are facing a novel structure that isn't in the database, you can actually submit your own highly specific, complex issues on Ind AS or Indian GAAP directly to the platform.
That interactive capability is what makes it a living resource. You submit your convoluted query, and a detailed, technically sound, well-reasoned response is formulated and delivered directly to the inbox of the email address you registered with.
It's like having a hotline to an expert.
It functions essentially as an on-demand technical desk for professionals who find themselves stuck in the mud of complex accounting interpretations.
It is a phenomenal service for the industry. Now, I have to ask, how did this specific zero-cost bonus share issue make its way out of the database and onto our radar for today's discussion? It wasn't just sitting quietly in the archives.
No, this specific scenario was far too interesting to remain hidden. It was highlighted and prominently featured in the 207th edition of the GAAP Advisors Task Weekly newsletter.
The Task Weekly newsletter. For those in the audience who aren't familiar, this newsletter is an absolute goldmine of continuous education.
It really is a must-read.
It is authored by C.A. Manish C. Iyer, the director of GAAP Advisors, and it is published regularly on LinkedIn. What amazes me is the sheer consistency and dedication required to maintain it. They have published over 230 editions to date.
230? That's a lot of issues.
Every single week, they take a complex, often controversial real-world reporting issue, dissect it, and break it down for the professional community.
The longevity of the newsletter is a true testament to the staggering volume of nuances and edge cases that exist within the Ind AS framework. The standard is not static. It interacts with evolving business practices.
Businesses are always inventing new ways to do things.
Exactly. There is always a new contractual interpretation, a newly engineered transaction structure, or a hidden pitfall to explore. The newsletter does a phenomenal job of ensuring that professionals remain sharp, updated, and highly aware of these complex edge cases before they encounter them in a live audit.
I strongly urge any listener who is active on LinkedIn, and if you are operating anywhere near finance, audit, or corporate strategy, you definitely are, to go search for the GAAP Advisors Task Weekly newsletter and subscribe to it for free.
It takes 2 seconds.
It is the lowest friction, highest yield method to continuously upgrade your technical knowledge without forcing yourself to read a 1,000-page standard book before bed.
Nobody wants to do that.
No. But let's play out the worst-case scenario here. What if a newsletter article or a repository search simply isn't enough? What if a listener is sitting on an issue that is so tangled, involving multiple interlocking contracts and massive financial stakes, that they need someone to actually look at their specific paperwork and guide them through the minefield?
For those highly critical, high-stakes, bet-the-company situations involving Ind AS or IFRS interpretations, there is one final, highly direct resource available.
What's that?
You can actually book a dedicated one-on-one consultation directly with the author, C.A. Manish C. Iyer, Through his professional page on company..Io.
Oh, so you can talk to him directly.
Yes. Sometimes the stakes are so high that you simply require a direct, nuanced dialogue with a seasoned expert to rigorously validate your proposed approach or to illuminate a catastrophic risk that your internal team hasn't even considered.
That is a phenomenal safety net to have. I feel like we are leaving our listeners incredibly well armed today, not just with the deep mechanical knowledge of how to handle one specific zero-cost transaction, but with the actual tools and platforms they need to confidently tackle the next 100 problems they will inevitably face in their careers. I'd call that a highly successful session.
I completely agree. We've taken a transaction that superficially looked like a harmless, invisible, zero-cost corporate event.
Just a free bonus.
And we've successfully illuminated the vast, complex web of mathematical valuation, asset classification, and income recognition that dictates its true economic impact.
But as is our tradition on this show, we refuse to let you leave without a final provocative thought.
We always have to leave them with a cliffhanger.
Something complex to mull over on your commute tomorrow morning, or to actively explore on your own. Now, we spent the last hour meticulously solving the puzzle of day one. Initial recognition.
Yep, the day it hits the books.
We figured out exactly how to calculate the fair value, how to get the 9.09 million rupee asset onto the balance sheet, and how to justify dropping that massive dividend income onto the P&L.
But I want you to think about what happens on day 365.
The inevitable complexities of subsequent measurement.
Exactly. The clock is ticking. When that mandatory one-year redemption date finally arrives and the subsidiary is legally forced to hand over the full 10 million rupees in cold, hard physical cash to redeem those preference shares, what happens to the holding company's books in that exact moment?
It's a great question. Remember, they currently only have an asset recorded at 9.09 million, but they are physically receiving 10 million in cash. Does the holding company recognize another sudden, massive gain on the day of redemption? Or a loss? How does the fair value of that bespoke asset shift, evolve, and mechanically grow over those 365 days between initial recognition and final redemption?
That is the perfect unresolved thread to leave hanging in the air. The story of this asset absolutely does not end on day one.
Not at all.
I highly encourage every single listener to open up their copy of Ind AS 109 and dive into the subsequent measurement rules for financial assets measured at amortized cost. Look up the highly specific concept of the effective interest method and investigate the mathematical process known as the unwinding of the discount.
Unwinding the discount.
If you can master how that 9.09 million smoothly grows into 10 million over 12 months, you will possess a formidable grasp of financial reporting.
It is a continuous, fascinating evolution. Well, I want to sincerely thank the audience for investing their valuable time and intellectual energy in learning with us today. Your time is your most precious, non-renewable asset, and we are deeply honored you chose to spend it trying to untangle the profound complexities of accounting with us.
We really appreciate it.
We kindly request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. Whether your platform of choice for deep analytical listening is Spotify, Amazon Music, or YouTube, we are there. Hitting that subscribe button is the single best way to ensure you never miss our next foray into the financial matrix.
And I have one final crucial request for our audience. Technical knowledge is only truly powerful when it is actively shared within the community.
Absolutely.
Please take a moment to share this specific deep dive among your professional contacts. Send the link to your colleagues. Drop it into your audit team's group chats or forward it to your finance department.
Spread the word.
And I want to place a very special, urgent emphasis on this. Please share this session with any students you know who are currently pursuing their CA or Chartered Accountant course.
Oh, that's a great idea.
These students are the future guardians of global financial reporting integrity, exposing them to these incredibly complex, real-world applications of Indian accounting standards, showing them exactly how the sterile theory they memorize in textbooks applies to massive, aggressive corporate transactions is absolutely vital for their professional development and for the long-term integrity of the entire profession.
I couldn't agree more. Send it to a CA student, challenge them with the Day 365 subsequent measurement question, and watch their analytical minds expand. Thank you all once again for joining us for this deep dive. Keep questioning the surface numbers, always keep looking for the true economic substance hidden beneath the legal form, and we will see you next time on the Gap Advisors Ind AS Clinic.